Hi, welcome to the Market Alert for Tuesday, the 22nd of November 2016. So, yesterday, we see the market trading out sideways. Then we had a sell signal. The market dropped down sharply to actually hit the scalp on this. And just for the record, I didn't take this trade, or the one that follows it, as what I said in yesterday's Market Alert. However, today may be different, but I'll explain why in just a moment. Then we got to 15:45, 15 minutes before Draghi was to speak, so this is why I didn't take the second trade. But notice how the market came straight back off the lows in this bar. Very important price bar. This isn't price action. I've spoken about it before. The market was shot down and then sprang straight back and then started to move to the upside. And if we move across on the overnight, you'll see that the market has continued just to move. Now this is very, very, very strange and weird. There's no doubt about that. And this is just market maker activity. I'll give its technical term for you in just a minute. But the market moving up there and now having made new all-time highs on the overnight. You can see we've broken the resistance at 18,970 and the market currently trading at what are we trading at the moment? 19,008 points there. So the Dow putting an all-time new high. There's a major problem with this. The market is showing that the prices are being marked up. There is no new buying coming into this market. It is just being marked up by the market makers. Nobody's selling into this market, and if nobody's selling into the market, then they are free to move it higher. You've got to keep in mind that we're in that period between Obama and President-elect Trump taking up office on the 20th of January. We're also waiting for the Fed to make the decision on interest rates, and that seems to be at 100% guarantee now that she's going to increase rates, and that's when the party will start after that. Again, more on that later. And so we've got this situation where the bankers are able to move the market higher. Don't forget, we're towards the year end. The bonuses are paid in January, and this is the perfect climate for them to actually move the market in one direction. There's no adverse news to move the market any other than to the upside. And speaking of news, before we get into the other types of news, we've got existing home sales today at 3 p.m. and that's about it. But they're going to move this market to the upside. I have said this in the Market Alert. They want the market higher. I keep barking on about this, and I wouldn't be surprised if we don't see 20,000 out of this before the market collapses. So it seems a tall order, 1,000 points. But listen, if you have a look at where we've come from the Trump initial sell-off to the high, we're 1,500 points up in less than 2 weeks. So that's the range, obviously, from down here to up here. But if not, even if you come from where the market was in a sideways move to where we are, ballpark, we're 630 points up as well. So you can see it's possible. Never say that it's not impossible. Let's see news-wise why this is the case. Well, if we have a look at the top here, equity market melt up. That's the technical term. It's called a melt up. It's a parabolic move. The market just shoots to the upside, and then it will blow out, and it will be game over. And as they recorded in the video that Trump is the fall guy. This is the precursor to that actually happening. You get these sort of, as I say, parabolic moves to the upside, and nobody's selling into them. They're all buying into it, and then they will just dump the lot. And interestingly enough, if you actually drill down into the detail, go a bit further down here, it's nice to see Zero Hedge actually moving away from politics now, which is why I've not been looking at this for a while. We see here as well the percentage of stocks in a bear market is growing. So what this means is that individual companies within the Dow, the S&P 500, the Russell, the FTSE 100, the German DAX, the CAC, all of these markets, the number of individual companies in a bear market are growing. It's just that you get one or two companies that are big players, and they can move the indices by themselves. The likes of Apple, Facebook, Vodafone used to be one that moved the FTSE 100 by itself as well. So you've got this situation, and of course those that are in a bear market will be, those companies will be having a dead cat bounce within those indices anyway. So the market will be bringing those share prices up even though they're bearish overall for the company. As the indices and the market moves higher, they will have a sort of a dead cat bounce thing like we've seen with Deutsche Bank in the last few weeks. So if you just peel away the layers, you can see what's actually going on inside of all of this. And again, the perfect clue is the implied volatility. As we've seen before, we're now broken the 11, we're at 1065. We want this down towards the 10 area. We've got plenty of time for this to actually happen because Yellen doesn't speak until the second Wednesday, I think, of December, which is not too far away now. Actually, it'll be 2 weeks tomorrow when she announces what she's going to do with interest rates. And like I say, if you at the moment that the bets are 100% that she will have to increase interest rates, and that's because of the yields on the bonds. And let me just grab those for. So here we've got a chart of the bonds. I've actually done this separately in a video, but I thought I'd just cover this for those of you who've seen the video, and I will put the link in today's market alert if you've not, about Trump being the fall guy. But since July, the interest paid on the 30-year bond has just moved sharply to the upside. We're now over 3%. We were down at 2%, and that's a massive increase in this market given the low level of rates. So it's a 50% increase in the yield on this, and this is why Yellen's got to actually increase interest rates because of the pressure in the background. So the bond yields have gone up, the market's lost a couple of trillion in price following Trump's election. I'm trying to keep things simple here, so I'm thinking about it before I say it. So the bond market's lost a couple of trillion, and the yield has gone up by 50% since July, and this is what makes things different this time rather than any other time as we approach the new year, that behind the scenes things are taking place that if you don't look for them you wouldn't actually spot. People want more for the risk of giving the government the money, and the yields are reflecting this. So there's been a bit of a sell-off in the bond market since Trump was elected, and these yields continue to move higher. And it's again odd because you don't normally get this when the stock market puts in new all-time highs either. It's generally not the case, but there you go. Right, that will do it for today. Should we trade or should we not trade? The answer is let's see what happens in the first half an hour. There may be enough momentum as we get this sort of melt-up effect that we can actually participate in it, but it's a case of just gauging it. As long as you keep the risk down, that's the key to this. And if you're unsure, then just paper trade or stand aside. So yesterday there was the one trade, but it was a quick trade as the market bounced back as well. So again, you've got to be thinking on your feet. The short side isn't the best side at the moment, as we've seen for the last few weeks because of the this moving prices to the upside. Now we've broken 19,000, 20,000 is in the headlights. Right, that's it. I will speak to you later today. Tuesdays can be slightly odd because everything's factored in from Monday, as I said before. And I won't be here this evening, so I shall be here this afternoon to look at the markets and see what is actually going on. So that's it for today. As ever, thanks for your support and also for watching, and I shall see you in the next one.